Something in the labor market just plummeted. Layoffs are surging, now over 1 million for the year and the highest since 2020. What is the current read on the state of the labor market? So, we got a couple notable data points for the labor market this morning. We also got some notable movements in the US bond market that we're going to take a look at. But remember, as a point of context, yesterday we got ADP private payrolls data out very, very weak, negative 32,000. Remember, the 6 month average in terms of private payroll creation, according to ADP, is only running at about 11,000 per month. Not only that, but the ISM Manufacturing Employment Index has been in contraction basically for 3 years. ISM Services Employment Index has also been quite weak as well. So, what do we get with Challenger job cuts? We got 71,000 announced. It is a pretty gloomy report. So, US based employers announced 71,000 job cuts for November. That is up 24% from last year. Now, remember, you have to compare month to month, August to August, November to November. November's total is the highest for the month going back to 2022. Now, back in 2022, we had an equity bear market. We also had 2 consecutive quarters of negative GDP, but we did not have an official NBER defined recession. It is the eighth time this year that job cuts were higher than the corresponding month 1 year earlier. That said, job cuts in November have risen above 70,000 only twice going back to the GFC. In 2022, of course, that silent recession that was not declared, and 2008, the GFC. Through November, employers have announced 1.1 million job cuts. That is an increase of 54% from the first 11 months of last year. Now, year to date, job cuts are at the highest level going back to 2020 when 2.2 million cuts were announced up through November. Which industries are cutting the most in November? Telecommunications, technology, food, services, retail, nonprofits, media, and news. Why are companies cutting? Now, restructuring led all reasons with 20,000, and store unit or department closing accounted for 17,000. Artificial intelligence or AI was cited for 6,280 cuts. Now, a lot of people comment it's not really because of AI. They're just using AI as an excuse. Challenger Gray and Christmas only reports whatever the firm is telling them. Market and economic conditions were cited for 15,755 job cuts. Tariffs have been cited for 7,900, with 2,000 occurring in the month of November. Doge has not been the cause of job cut announcements in the past 2 months, but is the leading cause for the year of 2025. Now, remember, about 25% of US GDP comes from government spending, and we just got some fiscal data for the monthly treasury statement, the budget for the federal government. We're going to do a video on that in the next couple hours, so stay tuned. The deficit is blowing out. Doge was not effective. They only cut about 1% of the total federal outlays, and we are back to running record deficits, as you will see in that next video. Hiring plans in 2025 through November, US employers have announced only 500,000 planned hires. That is down 35% from 761,000 announced at this point, or up through this point, for 2024. It is the lowest year to date total since 2010. So in 15 years, planned hirings are at the lowest level in 15 years, when 392,000 new hires were announced. Now, to show that, Zero Hedge provided a chart here, which I think illustrates it quite well. Here are those hiring plans year to date up through November. We can see that has been on a consistent decline over the past 5 years, and we are running significantly lower at about half the rate that we were going into 2020. Now, we also got initial jobless claims and continuing claims, which both came in below the market expectation. Initial claims are plummeting down to the lowest level going all the way back to October of 2022. Continuing claims also came in lower than expected. The expectation was for 1.96 million. We got 1.94 million. So continuing claims coming down is a good sign, as are initial jobless claims coming down. That is also a good sign as well. In fact, the 2-month rate of change for initial jobless claims are at the lowest level going back to December of 2021. Now, it's important to point out with gig work nowadays, a lot of folks are not filing for unemployment. They just go and work for DoorDash or Uber Eats or one of those sort of gig work sort of employers. Now, a look at the bond market. So we are getting some pretty notable moves in the bond market. Recently, Kevin Hassett was floated kind of in a trial balloon sort of manner as the next Fed chair. And the bond market is not responding too kindly to that. We are getting about a 7 or 8 basis point steepening between the 30 and the 2. Remember, what the pink line is showing is the difference in yield between the 30-year and the 2-year yield. The difference, how much more yield are you getting with the 30-year long duration bond, which behaves off much different dynamics. Remember, the long end is priced off of fiscal concerns, inflation, those sorts of things, much more so than the 2-year, which is priced off of what the Fed is going to do. We have been getting a steepening of the yield curve going all the way back to October. However, what we are getting recently is a bear steepener where the yield curve is steepening, but it is because rates are going higher. It is just that the long end is going higher at a much more pronounced pace. In fact, the 30-year yield is climbing to the highest level in many months now. As we can see, if we close up here, it would be the highest level going all the way back to September of 2025 of this year. This bear steepening indicates that the bond market is not too pleased with Kevin Hassett, who, of course, is very much a Trump stooge and going to just cut the federal funds rate maybe down to zero even. There's really nothing stopping him from advocating for incredibly dovish monetary policy, which of course would spark inflation. Now, taking a look at the cross-asset picture of how markets are responding to this initial claims data and the Challenger Grain Christmas, we can see the S&P 500 is down marginally. VIX looks like it is going to move higher in the near future. Bitcoin pulling back a tiny bit. Gold obviously doing okay the past week or two. 2-year yield is up. 10-year yield is up, and the 30-year yield is up. Of course, since Kevin Hassett was floated, the other notable move, of course, not only in the bond market, was in the dollar. So the dollar has been selling off pretty sharply over the past couple days, of course, with that Kevin Hassett, that turn toward fiscal dominance, where the monetary policy is not primarily there to serve the two mandates of the Fed, which is stable prices and full employment. But fiscal dominance refers to a Fed that is acting just to make the debt and the fiscal picture and the interest just to make that serviceable and manageable for the federal government. That's fiscal dominance is very inflationary. The last time we saw it here in the US was back in World War II and immediately following World War II. I will point out that inflation reached a peak of 19% annual rate of change during that fiscal dominance period of time. It is generally not good for bonds. And of course, back in World War II, they implemented yield curve control to prevent the bond market from pricing in that 19% inflation. They capped yields. Of course, it was very inflationary. So anyways, hopefully that was helpful. Stay tuned for the budget video we're going to put out in a couple hours, and I will catch you in the next one.